Hi everyone, welcome to another honeystocks.com weekend analysis. This one's going to be going out on the 18th of June 2022. Now before I do the usual and switch over to my screen share and walk you through many of the charts that you all tune in for, I just want to take the opportunity to once again thank everybody. I know my work that I've been putting out to social media has helped many of you out there, so there's lots of questions to answer this week, lots of charts to get into, and as always, I'll do my best to get through and make sense of what's going on with the broader market. Now, maybe just to give myself a little bit of credibility, I am working my way towards my CMT. Technical analysis is something that I'm very widely known for in professional circles. Now, the questions that I'm being asked this week are generally along the lines of the Fed response and of course the 75 basis points hike that we've had to kind of combat the inflation that we're seeing, and I'm sure most of us are feeling the squeeze in some shape or form. What we have to understand is that the market has already told us that we're heading into a recession. The reason I say that is the yield curve inverted a few months ago, and we are now technically in a bear market. We've got extreme fear, I guess, with market sentiment. We've got spike in volatility, and I think for many investors, it's really just a case of survival and really just not, taking part in the car crash that I think is really taken a life of its own over the course of the last few months. I am incredibly open-minded to what comes next. The market is forward-looking, as we all know, so what we're seeing at the moment is already being priced in, and there are some charts that would suggest that we are starting to approach some kind of level where we can look at the risk-to-reward propositions from a buying perspective. If you are new to my work, hopefully you notice a big difference between my work and every other technical analyst, day trading guru out there. I like to keep things simple. I am definitely not a day trader. My time horizon is mid-term. I use, of course, technical analysis, but I'm told that my work applies to many different styles. I'm probably more of a technical investor these days. If you were to sit and have a beer with me, that's what I would tell you. I'm very flexible, long or short, and I also use options as well. So let's dive into the charts. If you get some value from this, please do hit like and subscribe. It all helps with the YouTube algorithm and helps me out enormously, and I'd really appreciate it. So let's switch over to the screen share. Let's dive into some charts and let's try and make sense of what's going on. So let's start off with the 10-year Treasury note yield. Now, if you have been following my work across social media, which I understand for many of you that pick up the odd YouTube video here and there, you won't monitor my Twitter feeds and the content that I'm uploading on a daily basis. But I've been talking about the 10-year Treasury note yield now for quite some time. Now, it has broken out above its 2018 highs. Now, the reason this is important is it's been a massive headwind for stocks. Now, one of two things is going to happen here, in my opinion. Either the 10-year Treasury note yield is going to continue ripping higher, which will equate to the probabilities of declines across US stocks, or it's going to roll over, put in a failed breakout, and of course, hopefully the inverse will occur, and that would be a bullish driver for US stocks. So I'm watching what happens here with the 10-year Treasury note yield very closely. Exactly the same with the US dollar index. The US dollar has been, again, a wrecking ball for stocks. It's been ripping higher. Obviously, US stocks have been declining. So again, are we about to go on a massive breakout from a multi-year base, or is the US dollar index going to roll over? I think, from my perspective, in order for me to get super bullish on US stocks and to maybe start looking for things like market bottoms, etc., I think you probably have to see an environment where the US dollar index is breaking lower, and you need to see the 10-year Treasury note yield breaking lower. I think we all understand the economic environment is incredibly sensitive at the moment. There are so many things going on that is very, very difficult to keep up with. But I think when we default to charts, I think the understanding just becomes that little bit clearer. We already know, and I touched on it in the intro to the video, that we know that the yield curve has already inverted, which means it has dipped below zero. Now, the reason this is important is we know there's a very, very high likelihood of recession, and we know that stocks don't do well during a recession. I suspect when we have the numbers come out at the start of July, that we'll probably have a confirmation that we're in recession. It's just my opinion. We need to wait for the numbers to come. But will it be a longer recession or will it be a short recession? I don't have the answer to that. So for me, it's very much a case of assessing all the individual charts, all the individual stocks, just purely on their individual merits. There are stocks, of course, that are being massacred. Some are being massacred a lot quicker than others. A lot of stocks, good quality stocks, are holding up. And again, I've got a lot of really high quality stocks that are at very key support levels that I think could warrant a little bit of a risk to reward proposition. But let's kick it off with the major averages. Now, this is a massive headache for me. This is the Russell 2000. Now, the Russell 2000 has now posted a 52-week low, and it's now dipped below the COVID crash levels. Now, the reason this is important is it's a technical breakdown, and what we can often see with technical breakouts or breakdowns is momentum following through to the side that has been broken. So this is a big headache for me. The reason this is a big headache, and I think for those of you that have followed me consistently over the years, you'll all know that I have a belief that there's generally one index that gets the party started when we start to talk about massive declines or massive advances in the market. And my concern is that the Russell 2000 could now drag the rest of the averages lower. Now, we already know that the Dow Jones is flirting with the same COVID crash levels. This is a 200-week simple moving average. The reason that I use the 200-week simple moving average is for this chart. This is just an example. This is triple Qs. We can see that historically that this has been a decent buy point for when highlighting potential bottoms. There's a very clear difference, I think, the environment that we're in now versus the likes of 2020, 2015, 2010, etc. I think the general consensus is this is probably the most severe, but I do pay attention to the 200-week moving average. This is the S&P 500. We are, as I've touched on already, we are in a bear market. We have declined 24.5% in the S&P 500. And again, for those of you that have been following me closely over the last few months, way back in January, I put out my weekly letter, which I should say is completely free. It goes out to, I think there's 1,500 investors all over the world just for my free content. So feel free to go and sign up for that. But back in January, the headline was the rise of the bears. I think the message within that letter is has played out pretty well. So I think that might be something to consider, but we are below the 10-week moving average, the 10-month moving average, and that is a problem for me. We know that historically, when we start to get below these levels, it can represent bigger problems on the horizon. When we look at things like the financial sector, that looks like it could be a massive top to me. If the financials break down, would that be an environment where stocks are doing well? I'm not so sure. So there's a lot of charts here that are at critical levels. I think we need to see rebounds in financials, certainly in technology, to perhaps drive the S&P 500, etc. higher. And for those of you that picked up my letter last week, just calling for a pause in energy, textbook played out. ExxonMobil ran straight into 2014 overhead resistance, and of course what's happened is, with it being such a big component of the likes of XLE, etc., we've seen a sell-off in energy, which is not surprising to me at all. Lots of energy positions exited, certainly on my side, but it's a very, very tricky environment at the moment. Now, I did make the case that there might be some charts that I think might warrant some consideration. Now, what I would say is I'd like to draw your attention to the upper right of my charts. I have basic fundamental data. Now, this fundamental data has kept me on the correct side of most charts that I've been recommending, certainly to the downside, and that will become clear in a second, because I want to just show a comparison of the charts, the kind of charts and the kind of names I'm looking to potentially buy, and why certainly there are some stocks out there that I've been recommending to clients and members to potentially bet against. So let's just kick it off with Microsoft. Now, Microsoft has pulled back to a very logical level. Now, I highlighted this in our midweek halftime report to our investors, and certainly potentially that this could be a support level. I think it's going to be very much a case of what happens with the triple Qs, but certainly it warrants consideration. I think it's very, very easy to make the case if you do want to buy the stock. You do not need to take any massive risk with it at all. I like to manage risk. I think that's maybe the other thing to say, and I use things like trailing stop losses and so forth. What will the market do when we open up on Tuesday? Again, are we going to gap down? It seems to be what's happening. So we'll just need to see how the market opens on Tuesday. We've also got NVIDIA. Now, NVIDIA, the earnings growth on the last earnings obviously dipped a little bit. We've pulled back to, in my opinion, a big level for the stock technically. If it dips below 150, I think that's big problem for NVIDIA. But again, if the triple Qs rally, this could potentially be a buy point. We've also got exactly the same with Amazon. Now, the thing about Amazon is we've actually got negative earnings growth now. Just PE ratio is up at 50, which is quite high in my opinion, especially in the current environment. So I'm actually looking at this one as a potential stock that could break down. My criteria for stocks that are not safe, I think that's definitely the wrong word, but I think from a risk to reward perspective, I'm looking at stocks with negative 12 months earnings growth, really high PE ratios, and certainly with something like Novocure. Now, I understand that there are many metrics that you can use for fundamentals. I'm sure there's some of you watching this that are screaming at your computer, telling me I have no clue. That's fine, but what I would say is that these metrics have kept me on the correct side of most of the stocks that I've been looking at, and certainly I think technically looks like a bit of a head and shoulders pattern here, and I think if it breaks down below that 53, 54 level, coupled with, in my opinion, poor fundamentals, then that could be a big problem for Novocure. AMD, on the other hand, is one of those charts that I think decent fundamental data, potential bullish divergence. We have pushed down to 52-week lows, but when we have good companies, I always look for the failed breakdown, and if AMD puts in a failed breakdown and starts to move back above the 85, we know that with failed moves we can oftentimes get fast moves going in the opposite direction. So AMD is most certainly on buy watch for me. We've got PayPal, again flirting with another technical breakdown. It does have a bullish divergence, so there may be some kind of risk to reward proposition, but as we can see, it's in a very clear 50 period simple moving average downtrend. It's not a coincidence that price rallies into these levels and then just suddenly declines. So there might be some kind of opportunity for a mean reversion trade depending on how the market opens on Tuesday, but certainly that's how I'm currently seeing PayPal. Box, on the other hand, again, just want to give another example of recommendations, and there's no PE ratio on Box, and we've got negative earnings growth. This was a high conviction alert that was sent out a few weeks ago to our clients and members, and it met our downside objective on Thursday there. We've got eBay, again, another high conviction alert, negative 12 months earnings growth. Has a breakdown, and we posted a new 52-week low this week. Now, it might potentially rally a little bit here, but certainly I think that's one of those names that, yes, I think everybody understands that eBay's a bit of a juggernaut, massive 22 billion market cap, but again, it's one of those names that's in a bit of distress at the moment. Same with Zillow. Again, negative earnings growth, really high PE ratio. It's already in a massive downtrend. That doesn't mean that the downtrend is going to stop anytime soon, especially in the current environment. This was again another recommendation that went out last weekend, below 34. We're down at 29 at the moment. So the reason I wanted to highlight this one is if it does rally next week, I think the expectation is that it could potentially just rally, and it will offer an opportunity to go short on it, or buy puts, whatever your method for taking advantage of downtrends is. We've got Micron Technology, again, broke down this week. I actually owned this a few weeks ago, thinking that it would just be in a range bound and move from the bottom to the top. Of course, price told me otherwise. It broke down last week, and again, this was in last week's premium analysis to our clients and members, and it has broken down. So again, very similar to Zillow. I think if you get any kind of rally, provided that it's below 65, I think it's one of those names that could potentially take another leg lower. The other thing to say is it's a company that I like very much. Positive earnings growth, low PE ratio. So again, it might be one of those with AMD, if it breaks higher and puts in a failed breakdown and rips higher, then that would be a buy catalyst for me. But if it's below 65, I think it's one of those names to potentially bet against. Again, similar with stocks that have Bitcoin on the balance sheet. Back last month, I posted this chart to Twitter, just highlighting this exact thing. Obviously, Bitcoin and cryptocurrencies have fallen off a cliff, and we've got a situation with Block where it's got, again, negative earnings growth, really high PE ratio, and it's got Bitcoin on the balance sheet. So that's down from $80 down to $58. So I think certainly the bearish thesis is intact, and again, I'd be looking for this to rally, but I think any rallies is an opportunity to go short on. We've got AYX. Again, another recommendation this week to our clients and members. It's fallen away. It has rallied a note on Friday here, but again, if we're below $50 here, again, not rewriting any rules here. It's negative earnings growth, really high PE ratios, and those are the types of names that I'm looking to bet against at the moment. SoFi, again, I highlighted this one a few weeks ago when I did a social media analysis, just highlighting the importance of the 50-day simple moving average on this chart. Again, it's not any coincidence to me. We keep rallying into it and then it keeps selling off. So again, I'd expect some kind of rally into the 50-day, but given that there's no PE ratio, then that's a problem in the current environment. It doesn't mean I don't like SoFi. I think SoFi's got a lot of potential, but again, I think it's one of those names that's just been taken out to the woodshed at the moment. We've got ARC. We're flirting again with key support levels this week again. I was actually thinking this was going to fall off a cliff, and certainly, it's very difficult for Cathy Wood. I think, certainly when the rally was taking place after COVID, she got a lot of positive publicity, and quite rightly so. Just phenomenal performance that I don't think anybody really expected. And since then, of course, the growth names and the move into value and commodities has really hurt ARC really badly. And certainly if ARC wants to move lower, I think if it moves below that 34, 35 level, I think that's a really big problem. We've got the copper miners, again, Freeport McMoran, I'm sure it's a big one for many of you. It is in a sideways range at the moment. The problem I have is that we only reached halfway in this move before it declined. Now we know that the more times a level is tested, the more likely it is to break. We have tested this level now 5 occasions, so this is on breakdown watch for me as well. If you are in the camp that copper miners are going to move higher, there is certainly a favourable risk to reward proposition. But again, I think somebody like myself who likes to manage risk, I would certainly be looking to have some kind of stop loss placement below these levels. We've got Nike, again, potential reversal level. We're back to the scene of the COVID crash. We have pulled back 41% in this move. Again, it concerns me the more times a level is tested. I don't think consumer spending is going to be going up anytime soon. I think we're in an environment at the moment where we've got, certainly rising interest rates. We've got inflation, which I know, as I touched on at the start of the video, that is affecting many people at the moment. So Nike might be one of those names that you could potentially look to bet against if it breaks below these COVID crash levels. It doesn't mean that I think Nike is a bad company. I just think that it might be an opportunity to maybe start to think about hedging positions. And the market works exactly the same going down as it does going up. You can profit from it. The stocks, when they decline, are declining faster than they tend to go up, so it's actually an incredibly profitable way to play the market, provided you understand how to manage risk and all that goes with that. We've got DR Horton. Again, are we in a housing bubble? Are we on the brink of a housing crash? Well, we have broken below the COVID crash levels here. New 52-week lows posted. Now, I posted this chart to Twitter today, and one of my members commented on the post, and I'm in complete agreement. DR Horton is a great company. I said that in the post, but one thing that you have to understand, and again I touched on this at the start of the video, is the market is forward looking, and the market is now starting to look towards the future. And what this technical breakdown is really telling me is that certainly with the home builders and the housing market in general, we can look to Zillow, that there's a problem here. And it really is a problem when you have great companies like DR Horton starting to break down. So are smart people now starting to forward look at negative earnings growth over the next few quarters? I suspect that's what's happening. So new 52-week lows for DR Horton, and we've got Netflix, which is range bound at the moment, inside a tight 25% range. We know that with range bound stocks, you buy at the bottom, you sell at the top, and if it breaks lower, you just don't take any chances and you get out of town. And again, we've got Kite Realty Group Trust, massive PE ratio, negative 12 months earnings growth, and we're now posting new 52-week lows. So that's the weekend analysis. I hope you enjoyed that, and I hope you got something from it. Please do hit the like button and hit subscribe if you did enjoy it. I tend to upload every few weeks. If you are somebody that maybe has been struggling a lot over the last 6 months, feel free to stick around for a minute. Check out our website, honeystocks.com. provide technical chart and research. Of course, got fundamental data on my charts as well, but just to kind of give you an overview of what we provide our premium weekend analysis every single week to our clients and members, provide trade ideas. I'll show you what that looks like in just a second. Provide a midweek 5-minute halftime analysis. Got access to a wonderful trading community. I provide charting support on a daily basis. If you need a second opinion on a chart, I'm on hand to provide my own. And if you are somebody that would like to learn technical analysis and how to build charts and read the market, then you will have access to our complete technical analysis program, which I used to charge a lot of money for, but is now included with all our membership plans, which also comes with a 7-day risk-free trial. But just to kind of walk you through some of my work, you all know that I don't use the magical hindsight indicator. I call the market in real time as it's happening. A few of my recent calls, I think certainly with the small caps last year, back in November, I highlighted the massive headache that could give. I'll give a pro tip here. It generally starts with a failed breakout. Highlighting again the S&P 500 failed breakout, just highlighting 2 months previously what happened with the small caps, which fallen off a cliff. Back in January, calling for the valuation reset. You already seen that a few weeks after that, calling for the bears being in control. And if you want to go a little bit further back, my work got a lot of attention a couple of years ago. 10 days before the crash, I provided an analysis to our clients and members, which I will link at the end of this video. And again, it got a lot of our clients and members on the right side of the crash. But to show you what my work looks like, this is a recent one for Micron Technology. We've got Williams, COS, which did pretty well. Cloudflare was a massive winner. Square Inc, massive winner. Zscaler. Antero Resources was an absolute rock star for a couple of years. But I'm very, very unique in what I do. I log every single high conviction alert that's ever went out to our clients and members on our website. So feel free to go and check that out. The purposes of logging that is really just to show the types of stocks that I like to recommend and how these stocks go on to perform. I think it's very, very important to have transparency with my work. I don't know anybody else that does it, so feel free to go and do your own due diligence there. But I've logged every single high conviction alert over the last few years. Typically speaking, I'm very, very much quality over quantity. High conviction alerts, there's generally one, maybe two a week at the most. But feel free to go and do some due diligence. But I think we are probably a good fit for anybody that has a mid-term approach. If you are looking to get away from day trading, maybe you're just too busy with work, family, maybe you want to be part of a successful community, and maybe you're sick of hunting around social media, following 50 different people for ideas, and you want to be part of a community. Certainly, I think probably a good fit, but again, feel free to go and do your own due diligence. But I can't say any better than my members do. Some massive performances, that's options performance, that's certainly not stocks. But Sean, look forward to many more years as a member. Got Nick, I'll be a member for life. Rocco, guidance made his year, loves the community and of course the education side of things. Vince, again, massive performance, individual performances here and there as well. It really is a wonderful community. If you've stuck around to the end, thank you very much for watching, and I hope to welcome you very soon. Thank you very much.